the Russian gas to do it this time.
And if it comes from the United States, when does that become politically fraught because of what's going on here? And by the way, you asked the question, are we going to be getting redheads for weather for a long period of time?
New normal.
It may be, because where are we going to get the marginal extra supply? And I will just also add, this is part of the reason why small caps have outperformed, because they're not as associated with some of the FX headwinds, which people have been talking about. Just want to run you really quickly through some names that I'm looking at. Uber shares absolutely surging after they beat expectations. They have the drivers now coming back, and the demand very much still there. This really speaks to the consumer story. The consumers still have money to spend. Those shares up nearly 9% in pre-market trading. Airbnb shares also up about 2.5%. Mind you, both of these shares are down about 36% by the end of yesterday through the full year. So this isn't exactly a massive restaking of their claim and their valuation, but still, this idea of resilience in stocks that have been really beaten up. They report earnings after the bell. Las Vegas Sands is surging after China announced an e-visa system for Chinese tourists to travel to Macau. And there's just loosening up in general in China, or the rumors of it. And that's why you're seeing the ADRs of a number of Chinese companies, Alibaba, as well as Bilibili, which is a software company or some kind of gaming company. I'm killing it. And Yum China, which to me I think is really interesting at a time when, you know, basically they've had this situation with China Zero, rumors that China Zero might get abandoned. There might be starting to talk about some exit strategy. Things flying, officials come out, disregard, doesn't really matter. I think that's interesting.
I have this same thing with Jamie every single morning.
What?
My producer in the Open. He'll pick out a stock, and I'll be like, yeah, what does it do?
Yeah.
But Billy, I've never heard of that.
I know. Well, I looked it up. I saw that it was moving.
And please, you checked.
And of course I check. This is interesting to me. They are online entertainment services, genres and media formats, videos, live broadcast, mobile games, animation. I thought you'd be really into that.
No, I'm impressed.
I'm with John. JP Morgan's a moonshot. What's it mean?
Oh, Tom,
you know,
up 20%, something like that in October.
Yeah,
That's just a monster move.
Billy.
Bramo went there.
Okay, saving us right now in
like
foreign
Billy
exchange. Jane Foley will
You
join
like
us
a
now
stock?
with Robert.
No, I don't actually like it. Let's be
You
clear.
like the company?
It's just fun to say the name Billy. Say it. It's fun.
What?
All right, let's move on.
Jane's laughing at us.
Please, let's move on.
I would. Royal Dutch Shell is maybe just as fun to say. Jane Foley with us now, head of foreign exchange strategy. Jane, I did a fancy log study on the Bloomberg on Chinese yuan, USD CNY. And if you extrapolate it out on this moonshot of weakness, you get to 8 yuan in the summer of next year. Can you go through that exercise? Can you extrapolate out some of these beleaguered EM currencies, and particularly China?
Well, you know, again, the news that you were just referring to, will they pull out of COVID zero or not? Well, that's going to have a big leaning really on the market's expectations for growth in China, and therefore on the value of the renminbi, because we all know that Chinese growth this year is really disappointing, and we all know that, of course, a weakened economy means a weakened exchange rate. So those two things are really aligned. But you know, for many of the EM currencies or the economies, I think it really depends whether or not we're talking about commodities exporters, commodities importers, and certainly the ones that have been really struck by the energy crisis, really in some dire straits, or the food price crisis for many EM. Right. And you know, there is some degree of a doom loop for many of these now, and that's going to be really tough to break. And of course, I think we've talked about before, if you can look at the doom loop for emerging markets as their fundamentals keep on driving them lower, and that of course refers to that feedback loop with respect to the dollar too. People keep on holding the dollar instead.
Let's go to first principles off a Fed meeting tomorrow, and folks will have our coverage very dollar centric. Jane Foley, can central banks manage a dollar turnaround?
Well, you know, I think central banks would like a dollar turnaround. I mean, you know, there has been keeping up with the Joneses to some extent, and that's not just in EM. And we saw the emerging market central banks start hiking interest rates really before G10 in many cases. And of course, you know, you look at the Bank of England, you look at the ECB, you know, next time they go, I mean, the Bank of England obviously this week, but next time they go, they could be hiking into an interest rate hike into a recession. That's not something they want, and they don't really want to be doing 75 basis points, even 50 basis points into a recession. But of course, as long as the Fed does large increments, then because of the impact or the potential impact on their currencies, you know, that really keeps alive the possibility that they may have to go by large increments too, which crushes demand. This isn't just about a doom loop for for EM, it's happening here too. It crushes demand even more, which is clearly not what you want when you've got energy prices crushing demand as well. So if the Fed were to ease up, I think it would be a relief to a huge amount of economies around the world.
Okay, so if there is a step down, does that mean that we've seen peak dollar?
Well, not necessarily. And this is the interesting thing, because the dollar is a safe haven, the dollar also reacts to slower world growth. And so, I still come back to the question, until you can really answer, what else are you going to buy if it's not the dollar? Until you can really say, yeah, I really want to go and buy risky assets. I want to go back into EM, or, I'm confident in the euro. Until you can answer those questions, I think the dollar retains a fair amount of strength. And, with respect to the euro, yes, energy prices have come lower in October, and that's great news. But, it won't stop. It hasn't stopped, big chemical companies, aluminium smelters, pulp manufacturers moving out of Europe, because they know that it's not just about the cost of energy this winter, it's next winter and the one after that. Where is that energy going to come from? And I don't think that's something that the euro is really priced for yet.
So how much could we see the dollar continue to rally based on that backdrop, which is really poignant to think about industries moving out wholesale of Europe because they know this is not a one winter problem?
Well, I think we could still have euro dollar going lower, maybe not right in the near term, because the market is getting excited about the story that we've got this warm period and energy prices aren't as expensive as they could have been. But I think if we move into the proper winter over after Christmas into January, February, if it gets cold then, I think the reality of this weak set of data that we've had from Germany in terms of industrial production and manufacturing production, the PMIs, etc., that the warnings about recession, if they come into fruition, I think that's the sort of environment where we could see, euro dollar moving back maybe towards 95 or so.
Jane, final word on sterling. If you'd asked me just a few weeks ago whether this Bank of England would be selling assets, I would have said, I don't think so, but they are. Jane, is that currency positive or negative?
Well, I suppose, that the fact that they managed to pull their credibility back from the abyss, is a positive thing. We'll have to see how this auction is soaked up. But for now, I think the Bank of England, credibility, it's a good thing. But, I think the jury's out. I've still got a negative forecast for sterling. And that's really because, all of the sour fundamentals that existed before that mini budget on September the 23rd are fundamentally still there. In fact, they're worse because confidence has worsened, business confidence, consumer confidence, that sort of thing. We are headed into the recession if we're not already in it. So yes, in terms of credibility, both the new Prime Minister and the Bank of England, that's certainly a lot more solid than it was just a few weeks ago. But this is a tough set of environments in the UK that both are facing, and I think sterling is still headed for a pretty bumpy ride.
The pound against the US dollar right now, 115.35. The dollar weaker through all of G10. Jane, thank you. As always, Jane Foley there of Rabobank. QT, selling assets at the Bank of England. Lisa, here we are.
Yeah, and as she said, it's always a good thing when they can claw back their credibility. I mean, just to sort of elaborate on that, which was an off-the-cuff comment,
sure.
It is remarkable that they're able to actually go through with their plan and not cause massive disruption based on what's happened politically to really give them a bit of a reprieve on this. And that's actually testament to something. I mean, I don't know what, this is politically motivated, or whether Coach Lakota's comment, whether this is basically the Bank of England is in the driver's seat with fiscal policy. Yeah. But, how much is this really what we're looking at here with respect to their being able to go through with this?
I think it's important to recognize why they're actively selling and not just allowing balance sheet roll off. And that's because the average duration, the average maturity in the gilt market is so much longer that you'd be waiting a long, long time to get that balance sheet down. So the option available to the UK is maybe a little bit different compared to, say, the United States with the Treasury, the average duration, average maturity in the Treasury market being a lot shorter. That's
a great point. Also, they're focusing on short-term debt. They're not going to deal with the longer-term debt right now. So to your point, yes, most of it is in the longer term, but they're going to focus on the short end because of their concerns about the pension plans.
Big rally in both stocks and bonds today, and the equity market futures up 0.9%. In the bond market, yields lower across Europe and in the United States too. The 10 years down 11 basis points on a 10-year right now, 3.94. Live from New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden's promise to impose higher taxes on oil companies that pose windfall profits will be all but impossible to deliver. This proposal comes as gasoline prices are still high a week before midterm elections. Many Democrats have unsuccessfully sought a so-called windfall profit tax for more than a decade. No such proposal is likely to pass the current Senate. In Brazil, protests by supporters of President Jair Bolsonaro have intensified. Bolsonaro has remained silent over his loss in Sunday's election, refusing to concede defeat to Luiz Inácio Lula da Silva. Truckers backing Bolsonaro blocked the main highway linking Sao Paulo and Rio de Janeiro. Now, they said they don't agree with the results of the voting. Bargain hunters may be looking at Credit Suisse and think the bank could be the target of a hostile takeover. But Chairman Axel Lehmann says they'll end up disappointed.
We are going to strive again. So we don't have any takeover discussions, and at that point we truly believe we want to stay independent.
Lehmann spoke to Bloomberg in Hong Kong. And Bloomberg's learned that Tesla is sending workers from China to help with an expansion at its factory in Fremont, California. Now, it's a move that could help the U.S. facility ramp up production. About 200 people from Tesla's Shanghai plant will head to the Fremont facility on assignments that will last at least 3 months. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA. which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
I just see this huge quantity of global headwinds, and the US market is still discounting, 5 to 10% EPS growth for 2023, and that just looks way too high. So I still think the underlying earnings picture needs to come down a heck of a lot, and that would be a double whammy if inflation comes down along with growth.
James Anthony, just wonderful over at Aberdeen Investment Management, live from New York City this morning. Good morning to you. Your equity market is delivering quite a pop this Monday morning, or rather this November 1st morning, which is Tuesday morning. It feels like Monday, Tom, because it's your first day back. Futures up 9 tenths of 1%. Yields lower by 9 or 10 basis points on a 10-year, 394.89. And in the FX market, euro showing some strength. I can tell you dollar showing some weakness throughout the whole of G10. 99.31, Tom, on euro dollar.
Yeah, a little bit of weakness there. I would really note, as we talked with Jane Foley about some of the emerging markets, they're still showing weakness against dollar. I noticed Indonesia with its own calculus, and also China, 7.26 yuan is really quite a weakness, extrapolating out to 8 yuan, if you believe the math, out into the summer of next year. Someone expert on 7 or 5 or 8 yuan per dollar is Tom Orlick, chief economist for Bloomberg Economics, and he joins us now with much more of a tilt to his true expertise on China. I don't get it, Tom. You're going to explain it now. They're shutting down the Disneyland or whatever in Shanghai, and at the same time, a given luxury retailer, in this case Hermes, is opening a massive new store in Shanghai. Which story actually describes the greater China?
So I think you're right, Tom. There's a huge contradiction there right now. On the one hand, you have the China land of opportunity, the world's second biggest economy, a country of 1.4 billion consumers, perhaps in a decade's time, the world's biggest economy. That's the economy which companies like Hermes, if they're opening a big new store there, are betting on. On the other hand, you have the China which we're confronted with right now, a China with millions under lockdown, a China with a property slump, and a China where the PMI data for October is showing the manufacturing sector in contraction. I think if you're taking an optimistic tilt, you say this too shall pass, COVID-0 will come to an end.
Right.
Ultimately, the tilt away from property will be good for growth. It's difficult to see how we get there in the immediate future.
Okay, but if they turn the vector around, and let's just use as a round number, if they go from 3% to 3.4%, sort of all-in conversational GDP, what does that do to the greater Pacific Rim?
So China has historically been a very significant driver of growth in the Pacific Rim and in the world. So you've got your Asian neighbors, Korea, Japan, Vietnam, who are locked in to the Chinese growth cycle. And you've got your global commodity producers, Australia, Brazil, also tied in to the Chinese construction cycle. So right now, with China suffering from both COVID-0 and a property slump, that's dragging the region and dragging the global commodity markets down. The hope looking forward, and we had some hints of that on social media today, is that perhaps there's an exit from COVID-0 coming down the pipeline. Not tomorrow, not next week, but perhaps as we get towards the end of the first quarter of 2023, we're going to be looking at a Chinese economy opening up. Perhaps some stability has returned to the property sector. That could then look like a much more optimistic picture for China, for its neighbors, for the global commodity majors.
Tom, how much is this noise, though, at a time when Xi Jinping painted a very different future for China over the next decades than over the past decade, in terms of how friendly they were to outside business, in terms of what kind of growth trajectory they would tolerate? Are we still looking at a much slower growing China, regardless of COVID policies, over the next 5 to 10 years that really looks at more of a 4% growth rate than, say, 6, 7, 8%?
So it's a complicated story, Lisa. Right now, you've got some extraordinary factors weighing on growth. We've talked about COVID zero, we've talked about property. Those factors are not going to be there forever, but even when China exits from those drags, we're not going back to 6, 7% growth. You've got demographics, you've got debt, you've got more challenging relationships with the US who are blocking access to technology. That probably means that an optimistic scenario for China looking out to 2030 is growth in the 4 to 5% range. Now, layer on top of that Xi Jinping's stated view that the benefits of growth need to be shared more with Chinese workers and Chinese households, which means there's a smaller slice of the pie for entrepreneurs and certainly a smaller slice of the pie for multinationals and global investors. And I think that what that means is that the China investment story for the years ahead looks very different to the Chinese investment story from the years behind.
What does that mean in terms of the global picture here? When we talk about inflation and some of the economies moving out of there, if you strip out COVID zero as even a factor, are we looking at something that is much closer to a recessionary scenario next year and potentially much slower growth for a longer term period of time just based on the changes in some of these policies in China?
So you mentioned inflation, Lisa, and inflation, of course, is the big global story right now, looking ahead to meetings from the Fed, from the Bank of England this week. Now, ironically, the weakness in China here is actually giving the rest of the world an assist. Think about a world where China has ended COVID zero, pumped a bunch of stimulus into the economy to get through the property shock, lifted growth, perhaps artificially, but at least in the short term, back up to 5, 6%. That's a world where oil is really expensive. It's a world where metals are really expensive. It's a world where soybeans are really expensive. And it's a world where Powell and Bailey and Lagarde have a much more serious global inflation problem to deal with. So the weakness in China right now, certainly not good news for Xi Jinping, certainly not good news for investors in China. Perhaps it's giving a world currently obsessed with and inflicted by high inflation a bit of a break.
Hey, Tom. Great to catch up. Tom Orlick there of Bloomberg Economics. It's been a theme of this program through much of this year. Tom, you've brought it up many times. What if China comes back online? How much does that commodity market change if that's the case?
To me, it's science, and it's about COVID. There's so, and this is all the good reporting we had from Johns Hopkins and others through the crisis. Can you imagine if they applied some form of vaccination program? Which the logistics must be just overwhelming within China.
Away from the science. Let's say they go in that direction.
Yeah.
Where's crude the day that happens? Brent crude right now 94, WTI 87.70. Up and away.
Up and away. No question.
And isn't that basically what Tom Orlick's getting at here, Lisa? That, the world's got to pass based on the fact that they did COVID zero at a time where we've got some real scarcity of certain goods.
This goes to a question that you've asked many times, John, which is it good news or bad news if China really exits COVID zero? If this is the issue, right, are people underestimating the inflationary impact of the end of COVID zero at a time when perhaps the disinflationary forces are starting to control a little bit more of the narrative and all of a sudden, poof, and how does that deal with this stop-start kind of inflationary push?
Bloomberg Intelligence, John, 15% of UK mortgages fall due, and they look set to double the monthly payments.
Oh, it's brutal. We're going to talk about the reset in just a moment, and rates and business loans here in America, rent for small businesses. Oof. Not good.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg Crypto.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
I think the Fed is going to have to step down to a lower pace.
It's going to take time, and that's why we have this whole higher for longer mantra out there.
Stopping too early is a risk and could imply actually hiking further at a later date.
I just see this huge quantity of global headwinds.
Everybody is sort of waiting, sitting on their hands a bit, but they want to get invested, but we're not quite there yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. One day before a Fed meeting, we'll have coverage tomorrow afternoon of the press conference and such with Michael McKee. But right now, on 11/1, as we go through the fourth quarter, John, it's a bull market.
Is that what you're calling it?
It's a bull market.
Are you calling this a bull market?
I just looked at the move in the Standard & Poor's 500, and we have not broken the resistance of this great bear market. And that's the talking point into the end of the year.
I think a lot of people are still calling this a bear market rally. Monster month of gains on the S&P 500, even more so on the equal weight. Underperformance on the NASDAQ. Big tech got hammered, and it did not bleed. JP Morgan may be the standout for me, Tom. I think for you as well. Up something like 20% through the month of October. That's quite a squeeze.
I don't read the equity strategist because I'm triple leveraged all cash. You do. Let's go to Mike Wilson, who's been right. Give us a Wilson update.
Tactical call, short term, 4,100. 4,100. Wow. It's got a range of 4,000 to maybe 4,150 and leading into the upper range of that range. upper side of that range, yeah. He thinks that maybe you get that squeeze, but ultimately you have to confront some dire earnings that you'll see in Q1 23.
And that comes to the slowdown that Chairman Powell has to deal with. And Lisa, we heard from Julian Emanuel some real optimism there from Evercore ISI. And we heard from Jane Foley, the gloom loop or the doom loop, whatever she was talking about. She was on the edge of Rubini there. She was so negative.
Well, you're looking at a lot of potential headwinds. The idea that Julian Emanuel is talking about is the stock bond correlation will move in the way that you'd like. And it also will give rise to this ability to pick stocks, to talk about the equal rate, to talk about the Dow more frequently because it just had its best month going back to 76.
We've done very little Fed conversation today into this important meeting tomorrow. We've got the December meeting is important. Yeah, I know.
I was giving that to you in a silver platter, Tom.
No, but the important thing here, John, is we've seen a more accommodative Bloomberg Financial Conditions Index. We were restrictive, gloomy, and we're not into accommodation, but things have eased, and I wonder what that means for Jerome Powell tomorrow.
Should we check in on the real world, small businesses? Here's the quote from our story.
I think this is really important.
About 37% of small businesses, which between them employ almost half of all Americans working in the private sector, were unable to pay their rent in full in October.
Yeah.
And if you just compare where we were the month before, this is getting a whole lot worse from Massachusetts to New Jersey, New York, California, Pennsylvania. It's just a story right across the board.
Lindsay Piegza last week visiting us in her studios from Chicago, she was blistering in her first comment about this, that there's fancy people in New York and everybody else out there's flat on their back.
They're waiting for this to show up in the labor market. And in the meantime, it's showing up in other places. So it's set to get even more painful, potentially.
Lisa, the labor market, I mean, it is the heart of the matter. I wonder how he's going to address it tomorrow.
Especially when you don't want to see people lose their jobs, potentially millions of people, yet that's what people are calling for in order to get inflation under control. I do wonder the division between big business and small business. How much do small businesses have the power to both get some efficiencies of scale on the ordering side, while also not necessarily raising prices so much that they cannibalize from their business?
Do they have pricing power?
Right? Do they have the same kind of pricing power as some of the chains? And if that's that's what you're seeing in some of these pretty dire statistics about rents.
On the data front, to get started here, from 30.31, we've migrated down to an optimistic 25.82, John, on the VIX.
There's a lift right now in the equity market, up 0.9%. There's a lift in the Treasury market too. Yields are lower by 9 or 10 basis points on a 10-year, 394.89. I can't give you a why. I think Bravo nailed it a couple of hours ago. She's not even going to try, and neither am I. In the FX market, euro dollar 99.40 with positive 0.6%. So what have you got? You've got an equity market that's doing well, you've got a bond market that's doing well, yields are lower, and you've got a dollar that's weaker. It's kind of the reverse of the story of the last several months. Euro dollar 99.40, and crude. This is the one to watch, isn't it? Crude right now, WTI, $88 a barrel, at 1.7%. The rumors overnight that China might be dropping COVID zero or appointing some kind of committee to assess ways to exit COVID zero and all of that good stuff. And I will see, Tom, but certainly there's a lift in this crude market. There's a lift across the board.
I got to slip in the question here now to Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments in Houston. John and Lisa have got important financial questions. Can you explain to me, Victoria, why so many people hate the Houston Astros? We need, they're in Philly tonight. Thor's pitching for Philly. Can you give us some love so that the nation can embrace the Astros?
Absolutely. Look, this is the only team that has ever reached the ALCS 6 years in a row. They are consistent. They are on their game. They had an issue 6 years ago. People need to get over that and move on. So let's go Astros.
Whoa. Isn't that issue cheating? Wasn't that small issue of cheating?
Down in Houston, there's a small issue
6 years ago.
Well, because of time, we're going to move on
People
here.
need to get over it.
We'll have Victoria back for a really long break so that Pharaoh can brief on this. Victoria, if we move over to the market, is the bull market giving us Astros capability here? Do you believe in this lift in stocks?
Well, I believe in it, Tom, in the short run. I think we're going to have some momentum here. You've got really depressed sentiment. You have some of the technicals telling you that the market should continue to do well. So I think on the short term, yes, you're going to have this lift. But look, the Fed, in our opinion, is nowhere near the end of raising rates. They're going to continue to go. Whether it's 50 or 75 in December, we'll see what the data tells us. I think they're going to continue to raise rates in the first part of next year. So I'm not even looking for a pause until maybe spring of next year. And then we know they're going to hold rates there for a continued period of time. So I think we're going to continue to have that volatility in the market. Right now, though, we need some weak data in order for the Fed to start to talk about having a pause. And I just don't think we're there. Consumption is strong. Earnings, many people wanted earnings to just collapse this quarter, and we're not seeing it happen. Financial conditions are equal to where they were in June, so they're not tight enough to do what the Fed wants them to do. So there's really a mixed bag right here, but November is typically a strong month, especially in a midterm election year. So short term, I think you can see things do well.
So Victoria, there'll be some people waking up this morning, looking back on October, looking at the Russell, the small caps up 11%, looking at the likes of JP Morgan up close to 21% on the month, and wondering whether they should get on board with some of those themes that performed so well in the last few weeks. What do you say to them?
Yeah, I would say that they need to be tactical if they're going to be making some turns like that in their portfolio. Longer term, you do kind of that broad buy on weakness, sell on strength. That's what we're doing, kind of having a broad-based portfolio with diversification in it. But it doesn't hurt when you've got the dollar where it is and there's concern that you're going to continue to have a strong dollar because of the Fed raising rates more than other central banks, then yeah, so a little bit of small caps makes sense. We like financials, but we do think that when they run up significantly, you can trim a little bit of those names because we're going to have some pullbacks in this market going forward. So I think you can be tactical in some of those areas. Healthcare we like I said, financials we like, some of the staples we like, but trim on up days on some of these names and take some off the table.
That's the stock side. What about the bond side? Is the 10-year still the ballast that so many people were hoping it would be? It failed, and now people are re-upping their hope that this is the area, the store of value for the next few years.
Right, Lisa. So look, if the terminal rate for the Fed is going to be right around 4.75 to 5%, then the top out on the 10-year should be around 4 and 4 1/4. Well, we've been there for a little bit of time. So we've been short duration for quite a few years. We've been lengthening that duration in our fixed income portfolios using investment grade corporates to do that because spreads are actually holding in pretty well. So we think you can do that in your fixed portfolio, remembering that you're going to have market value volatility, but those bonds have a maturity date. So you can hold those until maturity and lock in some of these higher rates, as we do think as you go into next year, rates will start to fall.
Do we get in trouble for saying go Astros? Is that
no, not at all.
On the edge of trouble?
Let's go.
A firestorm of response.
I'm not sure if the
here.
sponsors will object or not. Hey?
I don't even want to look at Twitter after this. Yeah.
Victoria Fernandez across my Global Investments.
Talk to you in a couple days here and get it.
Can you imagine how that would work in marriage therapy? It was 6 years. Get over it.
You know, a very famous.
Can you imagine that?
I think that happens frequently. I can.
A famous market economist emailed it instantly. Thank you so much for watching. And he said, they cheat.
They cheat.
That's all he said.
And that's why they're disliked.
You know,
I didn't realize Thor was at the Phillies now. Didn't realize.
Yeah, I didn't know. He was at the Angels, and
he was at the Mets before that,
and they got it. You know, and they moved Thor over, and it'll be fun to watch. I haven't watched.
Guy's a giant.
To be honest. Oh, he is huge. Fun.
When I met him,
like Severino of the Yankees.
Yeah. Huge.
They're all big. The smallest. This is a great deception. The smallest guy in the field is huge.
Almost scary. Was it always like that? I look at Aaron Judge step up to the plate, and that guy's just absolutely.
Oh, he's
the guy's
monstrous,
a giant too.
But the littlest guy in the field is a big guy, is how I would put it. The days of normal are over. I would point out, John, that as we look at the Astros, and it goes back to Field of Dreams and the great Ray Liotta. I still can't believe he's dead.
Isn't that
the
crazy?
loss of Ray
I'm
Liotta.
with you.
And that was the whole Black Sox scandal from the 1920, whatever.
Love that movie.
And that I remember in my youth, there were people still talking about that in real time. The Astros, I don't think, equates to that.
When you were a kid on the ice, and you were about, how tall were you? 6'3"? 6'3", something like that?
No, it was
18, 6'3"?
It's taller. Yeah.
6'4"? Was that normal?
I was 1 year in the NCAA, the tallest player. In 2 other years, I was the second tallest player, and I was not good as the other guy. The other guy was better than me.
That's a scary sight.
Yeah. It was, but the big difference, we had shorter sticks. They didn't lengthen the stick for the tall guys.
So you were like bending down.
Vivi Chara of the Bruins had a real stick.
Bending right down.
I was hugely penalized because I had a Victoriaville 5-stripe that wasn't long enough.
Is this what you tell people in the bar about why you didn't make it?
Yeah, I didn't make it to the NHL because of my Victoriaville.
The stick's too short. Coming up, Henrietta Trays on a midterm. It's just a week away from New York. This is Bloomberg.
Keeping you up to date with the news from around the world. With the first word, I'm Lisa Mateo. Federal Reserve policymakers are expected to raise interest rates another 75 basis points at the end of a two-day meeting that begins today. Now, it's the Fed's most aggressive tightening campaign in 4 decades. Still, some strategists believe this stage of rate hikes is at an end, and the Fed will begin smaller increases next month. In the UK, Rishi Sunak's government says it's inevitable that all Britons will have to pay more taxes to restore stability to the public finances, especially the richest. Sunak met with Chancellor of the Exchequer, Jeremy Hunt, on Monday to discuss the budget. Now, according to the readout from the Treasury, they agree that tough decisions are needed on tax hikes and spending cuts. North Korea is threatening the U.S. with what it calls powerful measures if the American military doesn't end exercises with South Korea and others. The rhetoric may be an effort by Kim Jong-un to lay the groundwork for his first nuclear test in 5 years. Now, this week, the U.S. and South Korea started joint air drills after exercises on land, sea, and air in recent weeks. And a big takeover in the medical device industry. Johnson & Johnson is buying Abiomed for $17.3 billion in cash. Now, that represents about a 50% premium to the company's closing price on Monday. Abiomed develops technologies designed to assist and replace the pumping function of the heart. And Uber posted third-quarter revenue that beat estimates. The ride-hailing company reported a recovery in the number of drivers that supported increased ridership. Now, that should help ease investor concerns that rising inflation would cut into the number of people taking Ubers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
What do Formula One cars and your local supermarket have in common? Well, strange as it sounds, they might both be using the same technology. A lot of innovation has trickled down from the world of high-tech engines, and it hasn't just found a new life in road cars. F1 cars have long been thought of as the peak of cool, and technology in them is also helping to cool down our produce aisles. Engineers from Williams are using their knowledge from 9 Constructors' Championships, working with company Aerofoil to help reduce the energy consumption of supermarkets. The device they're building is based on the design of an F1 car's rear wing. It attaches to fridges to keep more cool air in the unit. They estimate it can reduce supermarket energy consumption by 25%. One innovation from F1 is also helping hybrids reduce their carbon footprint. That's KERS, or the Kinetic Energy Recovery System. In common parlance, it's known as regenerative braking and works by storing energy of the car decelerating in a battery for later use. If that's not enough, F1 is now looking at TERS, or a thermal energy recovery system, looking to harness the heat produced from braking and the engine exhaust. That could allow cars to generate the same power using 30% less fuel. So while F1 may have a reputation as a gas guzzler, some of its innovations in the name of speed are helping in the everyday fight against climate change.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer, Wednesday on Bloomberg. Markets expect another rate hike.
Investors obviously skittish.
What the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Tomorrow on Bloomberg, your global business authority.
What we do need is people pulling together to address the production issues and to address what happens on December 5th, because you could have a larger crisis in the oil market, and you need people cooperating, not at war with each other.
Brilliant to hear from Dan Yergin there, the chairman at S&P. From New York City this morning, good morning. Here's your equity market up 1% on the S&P. Let's check out the equity market. Just got a message from Michael DeVivio, who said this. Ranger Suarez is pitching for the Phillies tonight, Tom.
Big fan.
Yeah,
it's
apparently
fun.
Thor got bumped. Rain out allowed them
Thor
to bring
got
him back
bumped.
the game.
Oh,
yeah,
because of the rain.
Yeah.
Oh, interesting. That's a good surveillance correction.
There you go. Should we stick to football in future?
You're getting a big response from your NCAA view.
Seriously.
The British guy watching Saturday football. It's like, you know, it's a big
I think
deal.
Bama LSU this Saturday night.
Okay. I'm all Purdue. I just think Purdue, is destined. I think to play 500 ball this year.
Purdue?
Something like that. Right now, we will. I do want to point out equities with a new lift here. SPX 3922. That puts it up 6% to Mike Wilson's 4100. Only 6% up.
And how far away?
That's how we moved.
Sure.
Let's look at Washington right now. We do this with Henrietta Trey's, Director of Economic Policy at Veda Partners, but far, far more. Henrietta Trey's understands the process on Capitol Hill. Henrietta, give me the process of gridlock. If we presume gridlock Wednesday when we're in Washington for 2 days next week, what does gridlock look like next Wednesday?
Well, gridlock is usually something that investors love to hear out of DC. I have a lot of clients who are saying, does this mean we won't have to worry about DC for a couple of years? And I think that's definitely the case. The outcome of the Senate elections in our base case assumption is that we'd land at 50-50. Inconceivably, where we already are today, I anticipate the Democrats will lose Nevada, but pick up Pennsylvania, and you get left in this tremendous turnout election with the same thing that you've got now.
You've seen the theater in the rooms on Capitol Hill. Do you expect to see the theater of big oil executives saying, do you solemnly swear?
I think it's possible after the election, if Democrats, or specifically if gas prices continue to be particularly high, and if Democrats maintain the Senate, or if they maintain the House, I think there's a high likelihood that they would be called up. The windfall profits tax idea is something that I see as a 0% odds chance of passage, but it is a very convenient boogeyman to have going into the last week of the election cycle. Politicians love a boogeyman. They got a great one in Exxon and Chevron and the energy producers right now.
Henrietta, who is the boogeyman speaking to within the Democratic Party? To speak to sort of the polarization, how much is it the mainstream Democratic Party and how much is it more of the left side of it?
I think that it's Democrats trying to speak to pocketbook issues. They're trying to discuss inflation and explain to voters that they get the memo. They understand that gas prices are very high and it's a huge problem, and that's what they're being judged on by explaining that it's not them. And there's so many things for Democrats to point to, and Republicans as well. But on the Democratic side, I think they're just trying to find a message that resonates with voters that says, I appreciate that inflation is a problem. We have been doing our level best to get at it. It is not our fault. And that's really the main course of action with this windfall profits tax idea. And the same would be true for any congressional hearings that they held.
What proposals do Republicans have to bring down inflation right now?
Ironically, their main proposal is to extend the 2017 Tax Cuts and Jobs Act, which is the same as federal spending, fiscal stimulus, which is their primary argument why Democrats have gotten us in this position in the first place. Reckless federal spending. The 2017 tax bill was a $5 trillion bill, $1.5 trillion of which was pure deficit spend.
Henrietta, one of the great truisms we know at Bloomberg Surveillance, and you don't see it on radio, but you see it on TV, anyone in Washington with a bookcase behind them has the one volume of Ben S. Bernanke, which of course you've read cover to cover, is the only one in Washington who's done that, all 642 pages. Henrietta, will the Fed matter to a gridlocked Washington next year?
Well, I have to just defend myself here. Ben Bernanke once told me a joke about Elvis, and I will never forget it. So I'm proud to have that book behind me as someone who went through TARP and the auto bail and that whole disaster. I think all eyes are on the Fed. To your broader point, I think the hike coming is something that we have to anticipate. And my one holdover from the Great Recession, I would say, is that if you look ahead to what we have coming at us in 2023. High likelihood now of recession predictions by people in the United States and in the EU, and there is no appetite for fiscal stimulus out of Congress. So the only avenue we're going to have to stimulate the economy next year is going to be to have the Fed reduce interest rates. So as somebody who went through it, I know it's a nightmare for investors, but I'm happy to see it go up because it means there's room to go down.
Henrietta, what was the joke?
Oh my gosh, I can't remember, and I've never been able to remember, but it was about Elvis. Ben Bernanke told me, and I'm thrilled about it.
Henrietta Trey's of Veda Partners. Thank you so much. John, honestly, this sort of very human fabric of the past feeding into the future, you do wonder how much there'll be a less friendly approach to the Federal Reserve come not only this particular, I'm just saying.
I think it's starting, isn't it?
Yeah, I think that's already started.
I think we've seen it from a few Democratic senators already, and Tom, I think we're going to see it from a few more. As we work our way through the final week of campaigning.
We're going to go down there. And I would say, John, we don't know Monday next week or even Tuesday morning who's going to win many of these elections. The polling is that uncertain. So there's a real tension to Wednesday morning when we wake up.
Yeah, I'm not going to game the polls. But I think, it's pretty easy to make the assumption at the moment that we're going to see more complaints about this Federal Reserve, especially when you start to see unemployment go in the other direction. And if it's already starting.
And the Republicans, if they win the House, as is widely presumed, they pick up a Trump-like message and bash on a strong dollar much more than we've heard from the Biden administration.
Perhaps not at the dollar, but certainly at high interest rates. And Lisa, I think we've seen that 4 or 5 times already.
Yeah, and how much does this actually start to feed back to the Federal Reserve? There was an article that was actually really good today that came out on the Bloomberg, basically talking about how right now, basically reiterating what we've been talking about all year, the inflation and employment mandate are not in conflict, right? It sort of is still not that big of a deal. What happens, especially given the discussion that we're talking about COVID and the COVID zero policies in China, next year, if you start to get a little bit more disinflation, the Fed feels like they can ease back, and then bam, you get that increase in some of the supply side demand.
On the edge of optimistic, that was.
Well, no. I'm just saying, but then you get the surge in inflation from China coming back online.
Okay, sure.
So that's pessimistic.
Look,
too.
the labour market's a lagging indicator. We all know that. Unfortunately, at the moment, you're going to see cracks elsewhere. And if they're waiting, being emboldened by a lagging indicator to do even more, they're going to do even more damage, which is part of the argument to say slow down. Let's just see. You've got all that tightening in the pipeline. You've done 300 basis points already in 6 months. Wait. Heard that from so many people. Go back to the damage that's already being done. You can see it in the small business stats that we just went through 10 minutes ago. Small businesses are already suffering.
You can see it in the fact that many fewer people can actually afford the same types of things and are reaching into their savings. This is not an even economy with respect to the tiers of income.
Do you remember Carl Riccadonna?
I do.
He's going to join us shortly. Carl, you might remember him, Tom. It's coming up next.
Barnett, and I'm a journalist and presenter. This is my new show, Emma Barnett Meets. First, I'll be meeting Chinese artist and dissident Ai Weiwei, and I'll talk to the novelist and political scientist Elif Shafak. Tune in to watch those who shape our world explain how the world shapes us. This is Emma Barnett Meets on Bloomberg Quicktake.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
The difference between endless research and a winning strategy. To improve your firm's productivity and profitability, Bloomberg Law combines the latest in AI-powered tools and in-depth analysis to accelerate the research process. To grow your practice and make better use of your valuable time. The difference is Bloomberg Law.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
"60 minutes away from the opening bell in New York City. This Tuesday, equity futures up by more than 1%. The rally continues. Through October into November, equities up and yields are lower by 12 basis points now on a 10-year. That's a move, isn't it? Quite a move. 392 on a 10-year. Only a few Fridays ago, 433.
Do we know why?
Can't
My
give you a
second
why
time I've asked. 13
right now.
beeps.
I've got answers for you, Tom. Euro dollar, 99.43.
I agree. It's a mystery.
Weaker dollar, bonds a bid, equities a bid, crude's bid, 88.43 to kick off a brand new trading month, up more than 2%. A little bit of data later, JOLTS, job openings. Lisa went through this a bit earlier, and ISM manufacturing, Tom. Two of many data points during the next 24 hours.
Which is a constructive PMI here, above 50 or under 50? I have no idea
above
what that
50.
does.
S&P Global come out with their PMI, and I say it's in the United States is less watched than elsewhere. So in Europe, we'd watch that, and in China maybe too. We'd watch the PMIs there. But it's the ISM manufacturing number that seemingly historically has been the one that people watch a little bit closer, Tom. Okay. ISM manufacturing coming out at 10 Eastern. Have you seen this headline? Just right after we talked about it. Senator Warren, Senator Sanders asking Chairman Powell about recent projections and rate hikes. You're going to see so much more of this. And not just from those two candidates, because you'd expect it from those two, but you'll see it from others too.
You may see it from the other side as well. I mean, the tension picks up here. And again, this has to do from moving from ultra accommodative, good morning, Dr. Fisher over at BlackRock, up to accommodative and where we are now somewhere in neutrality. I've been guilty of this, speaking from 60,000 feet. Carl Riccadonna's on a glide path, landing with the Fed tomorrow. We'll have our coverage. He joins us now, Chief U.S. Economist at BNP Paribas. Carl, I want to drill right down to the press conference. Everyone's going to want to look out to December. How does Powell frame December tomorrow in the vicinity of 2:24 p.m.?
Well, good morning, Tom. I think that the challenge for tomorrow's press conference, obviously November is all about December, but the focus is going to be on the Fed's credibility around this messaging. And they've previously highlighted that they need to see some realized improvement in the inflation numbers, not just wishful thinking about a turn on the inflation data. And if we look at, for example, the core CPI, the 6-month annualized rate of change relative to the 12-month is not telling us things are moderating. So I think what could happen, I mean, the Fed is obviously eager for a downshift at some point, but I think that maybe Powell will take a step away from that, and rather than committing to December, he'll say, well, the time is approaching for a downshift. We'll let the data do the talking, and we have, before the December meeting, 2 jobs reports, 2 more inflation reports, and also 2 more rounds of inflation expectations numbers, which I think are exceptionally important at this moment.
Is the rate regime now, or what we're going to see in December or January, the same as it felt the last time we were at this level of nominal rate?
Well, I think that debt levels have gone up in the economy, and so interest rate sensitivity has only increased, and that's true relative to the last time we were at these levels, and it's true over the last 50 years as well. So absolutely, monetary policy is biting into economic activity. We see that very clearly in the housing sector. We'll see it through some other channels. You alluded to the manufacturing ISM out at 10 o'clock this morning, the strong dollar taking a very significant toll on the factory sector. We've seen new export orders slide into contraction, and I think that means that finally today the ISM headline will also slide into contraction as well. So we're absolutely experiencing multiple channels through which policy is tightening and reining in activity, and I think that means we're heading into recession next year. Maybe not so early as the first quarter, but I think by the time Q2 rolls around, we will have seen payrolls slip below 0 on a monthly basis, and consumers will have exhausted their excess savings from the pandemic, and the Fed will be at a level of about 5.25 on the terminal Fed funds rate. This will ultimately fix the inflation problem, but through the process, it will steer us into recession.
To fix the inflation problem, how long does the Fed, in your estimation, have to hold rates at that 5.25% level?
In my estimation, my team's estimation, we think that the Fed will be holding at that terminal rate of 5.25 throughout 2023, and then rate cuts could start in 2024, but don't look for the Fed to be the white knight it historically has been, riding to the rescue quickly and aggressively with rate cuts. Rather, they'll be much stingier with the lowering of the Fed funds rate, keeping it in restrictive territory. We're looking for maybe 50 basis points of cuts per quarter at the start of 2024. So it's going to be a gradual moderation of that restrictive stance of policy, because it is going to take time to choke the inflation pressures out of the economy. We're seeing inflation at the moment in very sticky categories, places like rents and services excluding rents, and historically it's taken more forceful policy action to bend the trend in those types of categories.
A lot of people listening to this might say 5.25% rates for a full year at a time when we haven't seen as much sensitivity this year because of some of the immunization of balance sheets that we've seen. Next year starts to get a little bit different. What are the contours of a recession with a full year or more of 5.25% Fed funds rates?
Well, again, Lisa, I think the recession probably starts in Q2 of next year. We have to be careful not to succumb to recency bias, as psychologists call it, and draw parallels to the last few recessions, which were exceptionally deep recessions, the COVID recession and the global financial crisis before that. I think the contours of this recession look more like a run-of-the-mill recession, if you will, and so if I had to draw a historical period with the closest parallel, maybe it's the 1990-91 recession. So I would look for, again, between 3 and 5 quarters of recession, probably 4 quarters of economic contraction, and look for the unemployment rate to back up from 3.5% as it currently stands to something in the vicinity of 6% at the peak.
But the critical thing here, Carl, and you've been a great student of history, for years, rolling back to your time at Deutsche Bank, and to me, the critical thing here is life goes on. If we get a Riccadonna view, life goes on, doesn't it? I mean, there's a whole gloom crew out there. We roll over and die. Just don't buy it.
Well, we don't roll over and die. There's still a decent demographic trend in the U.S., especially compared to a lot of our developed economy peers in Asia and Europe, for that matter. So there's population growth. Maybe we see some improvement on the immigration front, and all of these demographic factors mean that life goes on. As the population grows, then the economy gets dragged along with it. So you get hiccups along the way, and those hiccups are recessions. But structurally, there is still a growth paradigm in place.
Meanwhile, Senator Warren and Bernie Sanders putting out a note basically talking about how they want to talk better with Fed Chair Jay Powell about the path of rate hikes and some of the pain that it's going to inflict on the economy. If the Fed lacks the political will for whatever reason to get to that 5.25% level, how high could inflation be? I mean, what's necessarily going to be the length of time that inflation could remain high and the ramifications for the economy?
Well, if they lack the political will to really forcefully act against inflation, and I don't think that's the case by any stretch at the moment, a slew of Fed officials have made it very clear that inflation is job one, priority number one, and they will do whatever it takes to accomplish those goals. So as long as Jay Powell is at the helm, I think they will have the political will to make sure this plays out in an appropriate fashion. But if they don't act forcefully, then not only do you have higher inflation over a medium-term horizon, but possibly some disanchoring of inflation expectations. And that, for me, was really the last straw. John had mentioned crude oil prices at the start of the segment. Crude oil prices in the $80 to $90 range mean that the relief we've seen in gasoline prices over the last 100 days or so may prove short-lived, and we could start to drift higher in the coming months. And nothing antagonizes inflation expectations in the United States, including longer-run inflation expectations, than rising prices at the pump. We've seen this in the latest University of Michigan details for longer run. We've also seen it in the New York Fed's survey of consumer expectations on 3- and 5-year horizons. So I think in the back of their minds, Fed officials are looking at that notch up in inflation expectations. It's still in territory consistent with them moving back to their goal, but it's moving in the wrong direction. And I think this is part of the reason they may have some pause about really convincingly signaling a downshift for the December meeting. And instead they'll say, well, let the data do the talking. And if we do see some relief, maybe they can downshift to 50 in December. But I don't think we'll get kind of convincing table-pounding confidence on that point in tomorrow's press conference.
Carl, thank you. Got to leave it there. Carl Riccadonna there of BNP Paribas. Senator Warren and friends with a letter for Chairman Powell. It's about 5 pages long.
A long letter, yeah, a long letter.
Here's the quote that jumps out for many of you, I'm sure, which is on page 4, that recent statements from the Federal Reserve reflect, quote, an apparent disregard for the livelihoods of millions of working Americans. We are deeply concerned that your interest rate hikes risk slowing the economy to a crawl while failing to slow rising prices that continue to harm families. Lisa, Senator Warren and Senator Sanders, just two of many people signing that letter.
Yeah, 11 Congress members signing that letter from the Democratic side, talking about what the Fed's goal really is and what is necessary to potentially kill it. They also talk about how some Fed members have raised concerns about going too far. So trying to use some of the words of the internal debate, Tom, to try basically say, look, it's not worth it. And this really highlights an increasing political tension.
I want to really emphasize this is a carefully thought out letter with 7 questions at the end. John, question 6 is a doozy. Former Fed Vice Chair Richard Clarida recently stated, quote, until inflation comes down a lot, the Fed's really a single mandate central bank. Do you agree with that assessment? Did he possibly make that comment on our Fed show?
He made a few comments like that. There's a series of questions in there. There's 7, Tom.
7 questions.
About the forecast and recent statements, and this is going to be a key part of our conversation going into decision day tomorrow. And I imagine the chairman's going to get asked about this in the news conference too.
Window to 2023.
Without a doubt. In the next hour, pleased to say that Stuart Kaiser is
good.
now at Citi.
Good.
Got a new seat. Looking forward to this conversation at 9:30 Eastern. We'll catch up with Tiffany Wilding at PIMCO as well on Fed Eve, Fed Decision Eve. That's going to catch on. It's my new branding.
Oh, is that so?
Yeah, it's really working.
Keep telling yourself
It's really working.
What'd you guys for Halloween?
Ratings are through the roof.
Yeah.
Do you think I do Halloween? Honestly, come on.
You know.
He hands out sliced fruit to the children.
They didn't come round. No one knocked the door.
What a shocker.
Anne-Marie Horton had like, at one point, Anne-Marie Horton had like 14 kids at her door, throwing them Skittles and Reese's.
She actually went and bought a lot of candy for them too.
Yeah, I do that too.
The AMH is nice. From New York. This is Bloomberg.
And I only got one trick-or-treater. That was it. Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, SpaceX is set to launch its powerful Falcon Heavy rocket from Florida on a classified mission for the U.S. Space Force. Now, that launch could take place as early as an hour from now. Elon Musk's big rocket accounts for only a tiny fraction of the company's launches. The Falcon 9 handles most of SpaceX business. Bloomberg's learned that Musk's electric car company, Tesla, is sending workers from China to help with an expansion at its factory in Fremont, California. It's a move that could help the U.S. facility ramp up production. About 200 people from Tesla's Shanghai plant will head to the Fremont facility on assignments that will last at least 3 months. The Biden administration's restrictions on U.S. citizens assisting China's chip industry will be more narrowly enforced than feared. And that suggests a smaller than expected impact on semiconductor companies. The sanctions were introduced to keep cutting-edge chip technologies out of reach for China's military. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
If you do any kind of business in this country, there's a pretty good chance that you're going to see that business registered in Delaware. Why? Because that's where you do it. And our point was Wyoming can be that venue for blockchain enterprise, for crypto.
It's not the Wyoming way to sit around and wait for change. We want that independence, we want that freedom, we want that individuality. And that's a common theme that brings together bipartisan support for this in Wyoming.
We want to make sure that people understand, especially in Wyoming, but as the United States as a whole, this trend is coming. It's not going to stop. This is more of a small town that's growing into what I would call the cryptocurrency version of Silicon Valley.
It's the philosophy of that rugged individualism, the independence, and the ability to really get things done for yourself and control your own destiny. You get that from a blockchain, and you don't get that without it.
From the world of politics to the world of business. Balance of Power with David Weston. News, analysis, insight from and about politics power players. Weekdays. This is Bloomberg.
Next year, inflation will be lower, the unemployment rate will be higher, our major trading partners will be in recession, and the Federal Reserve officials will have a much harder time balancing across their dual objectives, maximum employment and stable prices. And the temptation to reverse course will be pretty compelling.
Vincent Reinhardt of Dreyfus and Mellon, their chief economist, and that is a gentleman that the people you listen to, they hang on every word he says about the dynamics of Fed. Head of research for all of the Fed under Alan Greenspan, and Dr. Reinhardt has written much on economic growth in America. Lisa Abramowitz and Tom Keene here. We're staggering to 9 o'clock here on a day before a Fed meeting, a nice lift to the market, and it continues forward. Lisa, I got to be honest, we've gotten more talk on Astros Phillies, a surveillance correction. Thor is not pitching tonight for the Phillies because of the rain delay. Mr. Suarez is. And cross-market pitch battle of anger right now as Victoria Fernandez in Houston says Stroh's and Robert Dahl, legendary equity strategist, is barely on speaking terms with his colleague at CrossMart.
I got a number of messages saying, how could you even think anything other than Phillies? The fact that Yankees fans are rooting for Phillies tells you everything that you need to know about the Astros. That's what I will say.
Mets fans are too, which is un-American, as we all know. Futures up 42 right now. Lisa and I thought this was so important that we should dive into it for a quick brief here from the gentleman in Hong Kong. Enda Curran, like so much of our Bloomberg team, Stephen Engel and others have lived the quarantine. He's Bloomberg Chief Asia Economics Correspondent. And I want you to speak of the nuances of quarantine that you have lived and observed in Hong Kong. Do you suddenly get out of it, or are government authorities easing out of it? Which is it?
Kind of easing out of it, Tom, in the Hong Kong sense. As you know, for the last few years, Hong Kong was more or less cut off from the rest of the world. 3-week quarantine in a hotel, then 2 weeks and 1 week. They have lifted that mandatory quarantine now, but there's still a fairly rigorous testing program in place, and that is deterring global business people and tourists from just landing here in a way that they once did. That's the international side, but don't forget on the China side, you cannot cross the border into Shenzhen yet because there is still an ongoing quarantine process involved in that. So, you know, where maybe other countries have flicked the switch, you think of Australia, they reopened and their economy got motoring again. Hong Kong has not been able to flick a switch. It's still kind of sputtering, very bad GDP actually in the last quarter. And the reopening story here is a long way to go. But I would say a lot of people are watching how Hong Kong plays out because it could be a prejudice for what China eventually does.
After the party Congress, I've heard very little about central bank monetary policy, the dynamics of large government money, even fiscal policy. Do you see a plan out there? Or is Beijing making it up as they go?
So what's happening at the moment is that they've actually just had the Congress, Tom, as you know. They've appointed a whole slew of new officials. Those new officials will be taking their roles over coming months, and in particular at the MPC in March. So the expectation is we're not going to get a dramatic retooling of the China economic policy story just yet. It will take time for that to be formed. There's an important meeting in December, the Works Conference. Keep an eye on, that's where they typically agree to growth target and the economic priorities for the year. So to your point, Tom, obviously everybody's asking when will the pivot come and when will they put support under the economy, be it on real estate or COVID zero. We don't yet know. All we know is there are certainly new officials going to be taking over key roles, and over the coming months we might start to hear some new language from them.
In the meantime, and we're hearing and we're seeing some of the economic data coming out of China that's been disappointing and pretty terrible relative to what China has been used to. How much is this becoming a pressure point at a time when people are now estimating a sub 3% GDP growth for this year for China?
It's a very peculiar downturn, Lisa. I mean, as you know, the whole story around China for decades has been it's a global growth engine. It's been a part of the world that keeps the rest of the world ticking over when there's a slowdown, but it's not happening this time. And it continues to deepen. You mentioned some more data. We had the official and the private sector manufacturing gauges today and yesterday showing that sector sliding into contractionary territory. And this is where it gets bad for China because you've got the domestic issue, which is COVID and the real estate story. But the PMIs are kind of reflecting what's happening globally, which is a big slowdown in global demand. So China's now going to be getting hit by both sides. And as I was just trying to explain to Tom there isn't a sense yet of when the turning point might come or when there might be a pivot for China.
But there's another question too, and it's not just COVID zero. It's that behind some of these numbers are companies directing some of their manufacturing out of China because of some of the unreliability of the policies, whether it has to do with COVID zero or whether it has to do with just how friendly the administration is to the rest of the world and global business. How much are you hearing about that on the margins, about people moving out of the factory production in China?
Yeah, so it's a tricky one, Lisa, because just to be clear, there has been a move out of China for some years anyway, because China has become more expensive than other countries. But remember, China was the place to do business over the last few years because it was motoring during the pandemic. It didn't have the lockdowns when the rest of the world was struggling. Now, to try and get to your point, though, there is certainly very negative sentiment among the global MNC set operating in China and indeed in Hong Kong. Everybody's talking about wanting to look for other options and move elsewhere. Where are those other options, though? That's a big question. Who else offers the scale and the infrastructure that China is offering? The FDI data into China isn't yet really capturing an exodus, but of course, you can argue what that data does capture, of course. But to try and sum up what you're getting to, yes, sentiment towards investment in China is very negative at the moment. It's a question of when companies will start to actually put some action around those words and move wholesale to another country somewhere else.
And the current, thank you for the brief, and all of Surveillance thanks you for late evening work out of Hong Kong today. Lisa, all sorts of things to talk about here, but I'm just going to frame up into a Fed meeting tomorrow of the real yield, something you watch all the time, is a general statement has run from 1.61% down to a lesser inflation-adjusted yield of 1.42%.
And to be clear, this is where yields are above the expected inflation rate over the next 10 years. A lot of people will look at this and say, real yields are still very negative because of just the reality.
It's just one measurement.
Of where, right,
Yeah.
it's one measurement.
Yeah.
This highlights the tension right now in markets that John and myself have not tried to explain today in terms of what's driving it. Are we reaching a feeling that perhaps the Fed has gone as far as they can go, or we've priced in expectations of that? Are we basically just seeing a short squeeze? Are we seeing people not know where else to go and seeing value right now in 10-year treasuries? You know, how do you give narrative to something that feels very technical at a time when the narrative is all over the place because nobody can really predict where we're going to be in 3 months?
I'm not going to game the narrative. I'm certainly not going to game short squeeze dynamics. There's a lot of people that do that to a great and quality extent. But what I will say is this is a Fed that is going into a meeting less restrictive than even 2 or 3 weeks ago. Because this meeting 2 or 3 weeks ago is a different meeting than what we're going to see tomorrow.
So will that color their view on perhaps giving a more hawkish tone so that they can say, guys, tighten it up so that we can actually achieve what we're looking for?
10:10 this morning, a meeting. Lisa Bramowitz will give a full brief to Michael McKee on what to say in the press conference
He'll be
tomorrow.
briefing me.
Please stay with us. Futures up 42. Dow futures over 33,000. This is Bloomberg. Good morning.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune in to Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg. Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
What a monster rally in October. Let's get November started. Live from New York City this morning. Good morning, good morning. Equities absolutely flying. The opening bell is just around the corner.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, we begin with the big issue. Hello, November.
Everyone's waiting for this Fed meeting.
The rate hike from the Fed on the 2nd of November.
The prospect of a slower pace of hikes.
A step down to 50 basis points.
Does make sense to start thinking about a slowdown in the pace of hikes.
75-50-50 is very doable.
It's really just going to come down to communication in the press conference.
They've boxed themselves into a narrative to save credibility.
Ken Powell talked about slowing down the pace, but still indicate resolve on fighting inflation.
The Fed meeting on Wednesday, the jobs on Friday.
We get the jobs data, but really that inflation data that comes afterwards. People are very cautious.
Everybody is sort of waiting, sitting on their hands a bit.
People are like, you know what, I'm going to wait.
Joining us now to discuss is PIMCO's Tiffany Wilding and John Hancock's Matt Miskin. Tiffany, first to you. Do you have some doubts that we drop away from 75 basis point hikes anytime soon?
Well, I mean, I think at this meeting, clearly we're going to 75. I think December, it's a closer call. Certainly the Fed can't hike 75 forever. We would see a pretty severe recession at some point, I think, if they did that. So they are going to have to slow. I think the question is, how do they communicate that slowing of rate hikes?
Matt Miskin, you think cuts are on the table in 2023? You still think cuts are on the table next year?
Yes, sir. The more they hike, the more they're going to have to cut, in our view. And right now, going into the Fed meeting tomorrow, you've got a risk-on rally, you've got oil rallying, you've got all this, just kind of pumping into the economy and markets right now of the wealth effect of just this market rally. And I think that's a bad omen for the Fed meeting. I think Powell's got to come in tomorrow hawkish, more hawkish than even the script probably was just days ago, because of how the market's reacting today.
So, Matt, just help me understand the sequence of this. You would fade the rally we've seen, but you also think this Fed has to back away and deliver rate cuts next year?
Yeah, exactly. I mean, near term, you see the Fed continuing to act hawkish, likely fulfilling the duty of the rest of the year, going 75 tomorrow, 50 by the end of the year. And then really we see a pause basically after that as leading indicators go negative as we enter a global recession. And then in the back half of next year, we see aggressive cuts because we're not going to get the fiscal stimulus again that we got out of 2020. We're not going to do $5 trillion in stimulus again. The Fed's going to be on the hook to get us out of the next recession. They're going to have to cut aggressively to do so.
There's a letter for Chairman Powell this morning. It was sent yesterday from a group of senators led by Senator Warren. I'm going to go to the quote on page 4. It goes through a list of statements, then asks a bunch of questions. After highlighting a series of statements, they said, quote, "It reflects an apparent disregard for the livelihoods of millions of working Americans. We're deeply concerned that your interest rate hikes risk slowing the economy to a crawl while failing to slow rising prices and continue to harm families." Tiffany, just your view, not so much on the letter, but the difficulty this Fed will have in getting inflation back towards target.
Yeah, well, I mean, I think the one issue here is that monetary policy works through lags, and we really haven't started to see the full impact of the rate hikes to date. And I think that's one of the reasons why the Fed, there's very good arguments for the Fed to pause, because they've done a lot. Let's see how much that actually impacts growth and inflation. You know, but I think at least the bottom line here is that, you know, we've got a lot of tightening in the pipeline that hasn't yet impacted the economy. Inflation is going to slow, as is growth, as a result of that. We also agree that you're probably going to see a recession starting in the U.S., maybe around the turn of the year, maybe a little bit later, you know, and eventually that is going to cool off the labor market and cool off inflation. You know, I think the key question is, though, is how much unemployment you need, you know, to really get inflation back to target.
Well, how much do you think we do need?
Yeah, well, I mean, our own forecast is that the unemployment rate goes back to something like 5%, 5.5%, something like that. You know, I think historically, if you look at the so-called sacrifice ratios, you need about a percentage point increase in unemployment to get the inflation rate down by a percentage point. So if you think that the underlying trend in inflation is 4%, you know, then kind of 2% increase in unemployment is what you need.
Matt Miskin, it's a pretty brutal business, isn't it? And a question I've asked a million times, how do they convince the American people that higher unemployment is a price worth paying to get inflation lower?
I don't think it's an easy one, John. And, you know, it's a difficult position to be in. But unfortunately, you know, you got to rewind. You got to say, how did we get here? And it was extreme circumstances. I mean, this is a 3 standard deviation event across almost every economic chart you look at. And when you have this kind of huge exogenous shock of the COVID pandemic, the subsequent stimulus, lo and behold, we've got too much inflation. And, you know, I think about waking up this morning with my kids trying to get them out of bed after eating too much candy last night on Halloween. I mean, that's what the Fed has to do. They have to be the parent that says the economy had too much candy and we've got to slow this down or else inflation is going to be embedded. So they've got to be the bad guy, the parent here, and slow down the economy. It's unfortunate. The cycle, the business cycle and the economy works in cycles. Unfortunately, this is the point where we've got to slow things down pretty dramatically.
Matt, does that mean leaning against the easing of financial conditions we've seen over the last month? Is that the job of the chairman tomorrow?
100%. I totally agree. And that's why we're saying fade a lot of the risk rally we've seen. October, everything got more expensive. Small cap stocks, large cap stocks, global stocks, you know, on the equity side, at least, and the risk on side. And we think that the high yield spreads at 450 is just not pricing in much tightening, much recession risk. And so we think that the Fed has to actually act a bit more hawkish, given this run and this huge rally in risk assets right into the Fed meeting.
Let's not lose sight of the fact that we are seeing some damage in this economy. We put out a story on the Bloomberg in the last 24 hours, and I'll read you a quote from it. 37%, about 37% of small businesses, which between them employ almost half of all Americans working in the private sector, were unable to pay their rent in full in October. 37%, Tiffany, and that's been rising month over month. Can you walk me through, Tiffany, as you look at the economy, the damage that is being done elsewhere? That's not showing up in the labour market report, may not show up in Friday's report either, but the damage that is being done elsewhere.
Yeah, Well, I mean, clearly the interest rate sensitive sectors, they are slowing. So if you look at the housing market, very clearly that is slowing. But I think that kind of maybe the broader issue is that, across a range of other areas, if you look at private credit, even sort of bank loans, things like that, it's been actually quite resilient despite the fact that these are floating rate loans. So I think that there's, it's kind of been, in terms of the actual transmission of monetary policy of higher interest rates across the economy, it's certainly not been even in any sort of the way. But I think a part of this gets to the kind of lags that I was talking about before. Some industries like the housing industry, they're the first to be impacted. That's why when we create recession models, we're using inputs from the housing industry because they do tend to lead other things. So again, I think all this comes back to the idea that we're still seeing monetary policy impact the economy. That's going to continue. We haven't seen the full effects of that. When we do, we probably are going to go into what we think is probably still going to be a modest contraction, but nevertheless a recession. And so we kind of have to wait and see.
Equities right now at 1% on the S&P. It's a rally that Matt Miskin and the team at John Hancock want to fade. The Nasdaq up another 1.3%. The outperformance of the small caps last month, absolutely phenomenal. The Russell 2000 was up 11% on the month. Biggest monthly gain going back to November 2020. This morning, it's not just equities advancing, it's bonds too. Yields lower by 11 basis points on a 10-year, 394. We'll get to that bond market move in just a moment. Katie Lyons, we've managed to find some common ground between Mike Wilson and the team over at JP Morgan.
Yeah, John, I wasn't sure I'd ever see the day when these two agreed on anything, and yet on one thing they do, and that is that this global tightening cycle is coming to an end in the not-so-distant future. Marko Kolanovic, of course, one of the most vocal bulls, says he thinks it will be in the first quarter of 2023 that all of this hiking comes to an end. He expects one more 25 basis point hike in the first quarter, and Mike Wilson, a vocal bear, seems to be in that camp too, saying that the end of the Fed's campaign to raise interest rates is approaching, and they are not alone in that. The likes of Goldman and Standard Chartered in that camp as well. To be clear, this is largely in line with what the market already expects. This idea of a step down is being priced in, which is why we saw such a strong rally in October. 75 basis points tomorrow is baked in by this market, then another 50 in December, and at least another 25 in the early months of 2023. Now, it's worth noting that it is going to be whether or not we get confirmation from Chairman Powell that really is going to probably make or break the day tomorrow. JP Morgan went and priced out what the different scenarios look like. They said the least likely scenario is we get a downside surprise of a 50 basis point hike, even though that could lead to a rally of about 10% in the S&P 500. Assuming the move is as expected, 75 basis points, the tone is what they think will make the difference. Dovish could mean a rally of about 3%. Hawkish could mean stocks fall about 1%. So we will see what tomorrow brings. The last thing I will say, John, though, is even if the hikes stop, as you and Tiffany were just discussing, it's because they want to wait and see what the economy does as it catches up to that. Monetary policy operates with a lag. If the hikes have stopped, but the earnings deterioration, the growth deterioration is really just beginning, is that necessarily a bullish thing for the equity market?
A ton of tightening in the pipeline still to come, and the damage, the consequences of this hiking cycle still to be seen. Katie, thank you. I want to get to this bond market. I've had a ton of questions on it this morning. Matt Miskin, I can't answer them. I hope that you can. They want to know why we've got a 10-year down 11 basis points on the session. Any idea?
Short squeeze. I think there's a lot of investors and globally right now, there's just been so much so much bearishness around the treasury market and the thought that sovereign yields were going to rise. And so I think there was just a lot of positioning one way, and now it's a buy everything type morning. I woke up and I was like, are we in high school all over again? It's a rumor that's driving this huge buy everything rally this morning.
On China reopening? Is that what you think this is, Matt? Largely off the back of those rumors on China reopening and dropping COVID zero?
I mean, it looks like, the epicenter is Chinese equities are up something like 5%. So that was the biggest move. I woke up, first thing I look at every morning, as you know, is the 10-year treasury yield, as we all do. But, that was down 12 bips. Then I looked at everything else, and it's like, it's just a buy everything morning. I think you got to be careful on buy everything days and months where everything rallies. We look at high quality income as a really great opportunity today, and high quality bonds are yielding 5 to 7%. But right now we would be cautious looking too much for a rally in bonds. Instead, we just want to get the income. We think the rally's more next year.
So Matt, just help me put the pieces together. Are you expecting that correlation between bonds and equities to break down anytime soon? Or are you waiting for that moment where we really start to see this economy break down?
We do believe, I would take the under on the current cross correlation in stocks and bonds. And that's one of the things that, it's a massive outlier. Again, we went through a 3 standard deviation event. We created inflation after 30 years of looking for it. And it took $5 trillion in stimulus. But if we get a more normalized economic and earnings and backdrop in general, cross correlations fall. And we think that's going to happen into next year.
Tiffany, I wanted to get a final word with you on your outlook for the economy. In your baseline is a shallow recession. I get a lot of questions about this, Tiffany, as well, on this specific point. What drives and shapes that baseline? Why does it have to be short and shallow? Why is that the consensus view right now on the US economy? And what's the balance of risks around that view for you?
Yeah, well, I mean, actually, we don't think it's going to be short and shallow. We think it's going to be a little bit more prolonged, so short and prolonged, as a result of the fact that you're not getting that counter-cyclical policy response. So you're not going to get the fiscal policy response to a recession, and probably the Federal Reserve is not going to be able to be as aggressive either because inflation is elevated. So I think you can see this kind of, really lackluster growth in, contraction first start of the year that comes back to, something sluggish and below trend for the latter part of the year. But in terms of why it has to be shallow, it definitely doesn't. And there's certainly downside risks here. And the downside risk is that the Fed's tools to deal with the high inflation are very blunt tools. So it's dealing, it has a sledgehammer to deal with something that it needs, probably a hammer for, some sort of other more refined tool. And in that kind of environment, financial market mistakes can happen. It's very unclear. It's very difficult to forecast ex ante where the, kind of the leverage is in the weakest areas of the market because we don't really see those until they start to be under stress. And of course, then it's too late. But nevertheless, I still think there are good reasons to believe this is shallow. Balance sheets coming into this, whether it be corporates, households, or banks, they were still pretty strong. So we think overall the system can weather, some financial market shocks.
Tiffany, Matt says cuts next year. Do you not see it the same way?
Yeah, I mean, I think it's certainly possible that the Fed cuts. And that's going to be, I think, is inflation coming down? We think that inflation probably does come down to around 4%. If the Fed sees, if they're forecasting it to come down to 2, even if we're at 3 or 4, I think it's certainly possible that they start to cut. Of course, if we're in a more severe recessionary scenario, then absolutely they'll cut. And just on that, I just want to mention that all financial conditions aren't the same. The equity market, the wealth effect, that actually has a less of an impact on the economy than if something like, a sudden stop in credit markets were to happen. That filters through to the economy and economic outcomes much more quickly. That would create a more severe situation. And in that situation, the Fed would absolutely be cutting quickly.
Tiffany Wilding, Matt Miskin, to the two of you, just brilliant. Going into the Fed decision tomorrow, equity futures right now up about 1% on the S&P. Matt Miskin mentioned that reopening rumor doing the rounds in China on social media that really drove equities higher in the Chinese session, and maybe that's bled through to the US session as well. A ministry spokesperson for the foreign ministry over in China was asked about this, whether the government had formed a committee to assess ways to exit COVID-0. Their words in response to that, he is, quote, not aware of what you just mentioned, when asked the question as to whether the government was forming a committee to assess ways to exit COVID-0. So there's the rumor. Is that a denial? I'll let you decide. Equity futures on the S&P 500 at 1%. Yields are in on a 10-year by 11 basis points. 394 on 10s. Coming up, President Biden keeping the pressure on big oil.
The profits are a windfall of war. Windfall from the brutal conflict that's ravaging Ukraine. It's time for these companies to stop war profiteering.
That conversation up next.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology. Welcome to Bloomberg Crypto.
Receiving historic windfall profits like this has a responsibility to act beyond their narrow self-interest of its executives and shareholders. I think they have a responsibility to act in the interest of their consumers, their community, and their country. To invest in America by increasing production and refining capacity. If they don't, they're going to pay a higher tax on their excess profits and face other restrictions. It's time for these companies to stop war profiteering.
President Biden threatening to slap big oil with higher taxes on massive profits, calling on companies to reinvest in U.S. production. BP pushing back on its earnings call, the CFO saying, quote, "It's really the supply chain that's choking activity right now. We won't ramp up production if we don't have a secure supply chain at reasonable prices." The team coverage starts right now with AMH down in D.C., Jack Facci in London, Maria Tadeo in Brussels. AMH, first to you. Was that a threat or a concrete policy proposal?
It was a threat, Jonathan, not a concrete policy proposal, really because of two reasons why. One is the fact that Democrats have floated this before, this year actually. They have control of the House and the Senate, and there's really no momentum to get this through. The United States has also done this before. We should remind everyone, in the 1980s, Carter, he had struck a deal with Congress. There was a windfall tax, really an excise tax, and it did bring in a massive amount of revenue. But you know what else happened, Jonathan? Production actually decreased, according to the research. And that's why you have people like Larry Summers just moments ago taking to Twitter saying he doesn't quite understand the logic of what the president's proposal is. But the logic in D.C. is that we are just days away from the midterm elections. And while every day you hear from the administration that gasoline prices are falling, Ron Klain, once again today, reminding everyone that gasoline prices are falling. The trend has been that way for the last 14, 16 days or so. The fact of the matter is, for months, it was higher gas prices that has really caused problems for this administration. And that is why you see the president coming out and making this speech. You can call this purely a political speech.
Jack, how are the energy companies responded to this week?
Well, it's interesting sitting here in the UK. We have a pretty similar debate, but I think the political battle lines are slightly different. We have BP this morning reporting its second best quarter of profits on record. The best quarter was the previous quarter. And I think companies here really are much readier to play ball with politicians that want to tax them more heavily. BP this morning saying we're all in backing Britain and it's up to the government to decide what to do. Similar conversation about potentially bringing more windfall taxes. Actually, we already have, which were put in place 2 prime ministers ago now, but only a few months ago, windfall taxes on the energy industry here in the UK, which include a loophole where the companies can avoid the windfall tax by reinvesting. So kind of going back to the kind of thing that Biden was talking about yesterday. And likewise, Shell, we had talking last week and saying actually the oil industry needs to embrace higher taxes. This is a difficult moment. People are struggling. The money needs to come from somewhere, and we're making lots of profits it should come from us.
Well, perhaps because the threat is much more real in the UK and across Europe than it might be here in the United States. Maria Tadeo, some good news. Some good news. Can we sit on that for a moment? I never thought I'd see a red headline about the weather across the Bloomberg terminal, about European weather in the month of November. Maria, how good is that news?
And Jonathan, I had no idea that my job description would also include the weather report. This is a career detour that frankly I was not expecting, but this year is very relevant because the weather, this is everything when it comes to the energy crisis. And Bloomberg has spoken to a number of meteorologists from Marex to Météo France, and they say that they see and predict a continuation of this mild weather in November. For the time being, no big cold spells. And Jonathan, this is entirely anecdotal, but I know that today, November 1st, I came into work with a sweater. I know in my apartment, granted, I'm never there, but the few times that I've been in my apartment, I've not had to turn on the heating yet. And this is very relevant because of the implications for storage. If you delay that season, the heating season, by 2 to 3 weeks, it means that, of course, your money, you pay less because you don't turn on the heating. And then 2, the storage is intact. And everyone that I know that monitors the energy crisis, they tell me it's the 2 things you have to watch out. It's the weather, but it's also the storage. And by the way, going into the windfall tax, in Europe, there is already 1, as you know, and some countries even have 2.
Maria, thank you, alongside AMH, and Jack as well, to the 3 of you. Thank you very much. There is a rally in crude today. Brent crude up by close to 3% now on Brent, 95 handle on Brent crude. WTI 89, just short of 90. WTI up by more than 3 percentage points. We'll pick up on that story in just a moment. Coming up, the morning calls and later. Good news is good news for markets. That's the view of Citi, Stuart Kaiser. Stuart in a new seat. Looking forward to catching up with him in about 7 minutes' time. The opening bell coming up shortly. Equity futures absolutely flying up 1%. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Minutes away from the opening bell, equities up across the board. On the S&P up 1%, on the Nasdaq 100 up by 1.26%. That's the price action. Here's some morning calls. JP Morgan upgrading Carvana to neutral, seeing a more balanced risk reward after plunging 95% over the past 12 months. Next up, Wedbush downgrading Steve Madden to neutral ahead of tomorrow's earnings, recommending investors move to the sidelines due to the weakening macro environment. That stock down 2%. And finally, RBC Capital upgrading Norfolk Southern to sector perform, highlighting the company's solid operating trends and impressive quarterly results. Their stock is up by around about 1.7%. Coming up, it's the opening bell, and Citigroup's Stuart Kaiser seeing upside risk to markets. That conversation just around the corner. S&P 500 futures up about 1%.
is there still room for Abenomics to be carried out in full in the way that Shinzo Abe imagined it?
The economic situation that Prime Minister Kishida faces today is very different from the one that Abe Shinzo was faced with when he became Prime Minister 10 years ago.
Does Japan need a new policy? Is that what Kishida has to learn, or are there parts of this that he should hold on to?
I think there are probably parts that he should hold on to. I think the main challenge which Japan faces is demography. The population is declining, rapidly aging. Women are totally underused in the labor force, especially educated women. One needs to think about increasing immigration. These are issues that Abe tried to address, but a lot more needs to be done to quote-unquote revitalize Japan.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg. Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrell. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
24 seconds away from the opening bound this morning. Good morning to you. Kicking off November in a pretty strong way, for the bulls at least, up by about 1% on the S&P. Futures advancing on the Nasdaq, up by 1.3%. The month of October, really, really solid for the likes of the S&P 500, up about 8%. The underperformance on the Nasdaq, the outperformance on a Russell. We'll get to that in just a moment. There's the opening bound. Switch at the board and get to the bond market. Yields look like this on a 10-year, all the way in, down lower, -9 basis points on a 10-year, 395.51 on 10s. In the FX market, dollar showing some weakness, euro showing some strength, 99.39 on euro, dollar positive 0.6%, and crude advancing, WTI just short of 90, $89 a barrel, up by close to 3% on the session. We open up then, about 20 seconds into this, advancing 1% on the S&P, on the Nasdaq, up by 1.5. China, overnight, absolutely flying on reopening rumors, speculation that policymakers are preparing to exit the country's COVID-0 policy. Kelly Lyons has more. Hey, Kaylee.
Hey, John. Rumors, speculation, very important words to use here because this is all based off of an unverified social media post that was circulating in Asia overnight. So we should stress this is unverified. But what that post said was essentially that China is looking at formulating a committee to discuss options to exit COVID-0 policy. Now, we should note that a Chinese foreign ministry spokesperson was asked about this. He said he's not aware of any such a committee. So by no means is this a confirmed reopening thing that is happening, and yet the market is running with it nonetheless. The Golden Dragon China Index here in the U.S. up about 6.5% at the open. The likes of Alibaba, Baidu, JD.com, all the big tech players that saw their Asian listings rallying hard overnight are rallying hard here in the U.S. as well, each up to the tune of 7.5 to 8.5%. And you're seeing it show up in casino stocks too, which a lot of them have significant revenue exposure to Macau, a gambling enclave that could benefit in a very big way from more Chinese travelers. Already, the likes of Wynn Resorts and Las Vegas Sands were rallying yesterday after a travel update from Chinese authorities that said mainland residents can apply for electronic travel permits for Macau beginning today. So those gains being added to this morning on the additional optimism coming through. Wynn Resorts over the last 3 days now up about 20%. So that's what's going on with the U.S. listed names, John. And we did, of course, as you mentioned, see big moves in the Asian region as well. But I just want to keep the context of how we are coming from and how far we still have left to go. The Hang Seng Index is down about 43% since the start of 2021, suffering not just because of COVID-0, but also a regulatory crackdown from Beijing that has weighed heavily on a lot of these technology names. That index still in a bear market, still below its 100-day moving average, so there is a lot more work left to do on any kind of recovery, John.
If you're asked about something and you say you're not aware, is that a denial? Kelly, can we call it that?
It's a good question. At the very least, it's a dodge, so we'll have to come back to him later, I'm guessing, John.
Kelly Lyons, Thank you. That was just what I was thinking this morning when we got a big rally and that particular individual at the foreign ministry in China was asked about it and just said, I'm not aware of what you're talking about. Apparently good news could still be good news for markets. That's the view of Citi Stuart Kaiser. He wrote the following: tail risks on the inflation side remain extreme, and we see good growth data, even payrolls, as positive for markets, as it lets the FOMC devote 100% of its attention to those tail risks. Stuart, I'm pleased to say, joined us right now. And Stu, can I just say, fantastic to see you in a brand new seat. So congratulations to that. And then we can get straight to the interview and talk later about how fantastic you are. Stuart, good news is good news. Is that a change, and why?
You know, I think, Jonathan, good morning. Thank you. I appreciate the compliment on my suit, of course, as well. I put a lot of work into it. For me, it's not a change. You know, I've been quite surprised by the narrative that folks want growth data to deteriorate for the markets. And I mean, I sort of understand the logic in the sense that there's a view that the unemployment rate needs to rise for inflation to come in. But in our view, you know, the Fed is dealing with inflation tail risk, and they're committed to doing that, and allowing them to focus on that without growth data deteriorating meaningfully, you know, we think is actually a better outcome for markets, you know, in the near term. You know, clearly there's a level of inflation at which the Fed can, you know, make a trade-off decision between inflation and growth risks, but we are just nowhere near that at this point from an inflation perspective. So for us, you know, whether good news is good news or good news is just kind of neutral news, it's hard to say. But from my perspective, I'd rather the growth data remain solid and open up a window for the Fed to really just fight inflation and get that tail risk under control.
So tactically, you're positive on this market, Stu, and I wonder if that means, based on what you've just said, in the short term at least, you're expecting some more good news.
Look, we were positive last week, definitely around earnings and with the market moving higher. I think obviously one day ahead of the Fed, it's a little hard to carry a whole ton of risk into that event. But, you know, big picture, I think we're at a level here where we're sort of in no man's land at about 3,900. I think once you get above 4,000, you'll start to get the macro community, you know, leaning short against the market. You know, earnings continue to come in, not great, but I think better than what the bear case was, and positioning is still light. So I think there's a case to be made that the market can move a bit higher, you know, from here and from where it was last week. And then you probably do run into a little bit of a hard ceiling, right? You know, the Citi base case is still about an 80% chance of recession, you know, 60% that'll be mild, and then 20% that'll be hard landing. So when you've got that kind of recession risk on the horizon, it's hard to kind of be structurally bullish. But I do think there's a window here where the market can continue to move a bit higher kind of post-FOMC.
You mentioned positioning. As you look across the equity market, where and what is vulnerable still to a short squeezed based on what we saw last month?
You know, it's a great question. If you look at the flows we saw last week, you know, through the Citi franchise, were frankly buying of stocks that looked like value, high quality, and low risk. And if you took a step back, you'd say, well, the value trade has been very exposed to higher rates, so you can understand why folks would be going there. And then kind of high quality and low risk are a place you might want to hide out in a recessionary scenario. So that combination to me says investors are voting with their feet, and they expect, you know, rates to move a bit higher and that to kind of increase recession risk on a go-forward basis. So I think that's where flows are going. You know, what needs to be unwound or where is that risk? I think it's frankly in the growth stocks, right? You know, for basically 10 years, you had folks buying growth. And if there's one area that there's probably still overweights across, you know, a lot of the investment community, it is there. So that's, you know, I think one spot maybe you haven't seen a complete capitulation, though to be fair, those stocks are down quite a bit. And then I think it's on the value side where you could still see some folks get dragged into the market again.
Would you play that at the index level? The reason I asked that, Stu, is because we saw the NASDAQ 100 last month up almost 4%, clear underperformance relative to, say, the small caps. The Russell was up 11% last month. Is that something you'd play through those two indexes? What would you do?
It is. I think, you know, we've been sort of pointed to long S&P, short NASDAQ as a way to express that view. But to your point, you know, long small cap, short NASDAQ is a very similar implementation. It might have a little more kind of juice to it. So I think at the index level, you know, that is where you want to be going after it. That trade, though, has been extremely volatile. You know, 2 weeks ago, you had NASDAQ up, I think, over 500 basis points relative to small cap, and then that almost completely reversed last week. So, you know, you can do it at the index level, but even on a long-short basis, it's a hold tight kind of trade. But that is how we would express that view at the index level.
Stuart, what would make you a little bit more constructive on these tech names? What would make them attractive to you again?
I think it just all goes back to inflation and terminal rate. I think a lot of this, if I look at what's going on in the market, you have policy uncertainty, you have uncertainty about a recession, and then you have bond volatility. I think all three of those are just different labels for the same thing, which is inflation uncertainty, right? Because inflation is so high and uncertain, policymakers can't give us guidance. We're not sure where the terminal rate's going to even out, and that's resulted in bond volatility, which has obviously been very negative for equity markets. So I think to get more comfortable with the tech space, you really just need to have more clarity on where terminal interest rates are going to be. And then folks can do their math in terms of what do they think is fair valuation for those stocks. But, if the terminal rate right now is, estimated at kind of 4.8, give or take, if there's a risk that could be 5.5, it's just a very hard risk reward to step into those tech stocks. So I think it's more clarity on the policy outlook and where that terminal rate's going to settle into.
Big run up in stocks this morning. About 8 minutes in, we've got the S&P up 0.9%, the Nasdaq 100 up by 1.2%. We talked about those Chinese listed stocks. Could talk about the ADRs as well. Take a look at Alibaba, up by more than 6% this morning. Stu, can I ask you the China question? You said good news might be considered good news. If China does reopen, if they drop COVID zero, and all these rumors swirled this morning about the government potentially putting together a committee to assess whether to drop it or not. If that happened, would you consider that good news for this market? What would that ultimately mean to you?
Yeah, I think on the margin it's good news because that should increase demand out of China, right? And when folks are really worried about global recession scenarios, I think China reopening, Chinese citizens being able to maybe travel globally again, which they haven't for a while, would be positive. That said, as Kayleigh mentioned, this is an issue of COVID, but it's also an issue of regulation. So I think there's probably a limit to how much Chinese assets can re-rate. But big picture, I think if you're reopening the Chinese economy, that's a huge demand driver for global growth. It's going to be positive, for global growth expectations, which I think ultimately is positive for equity markets.
On net, though, when you consider what it would do to the commodity market, where does it leave you? Because that's what I'm struggling with, and maybe I'm thinking a little bit too hard about it. I see on the supply side of the story, great news. Supply chains just start to recover even more. You bring back some demand just as Europe and the United States is turning lower. But then you consider what might happen in the commodity markets, Stuart. You can construct an argument whereby the Fed has to do even more because inflation starts ripping again.
Yeah, look, it's definitely a risk. If you pushed oil prices higher, that's going to obviously be an impulse onto headline inflation. That said, I think folks are pretty well priced here for upside oil and inflation risks. And having that demand recover, and to your point on the supply chain as well, I mean, if we were to list out the drivers of the initial surge in inflation, you'd probably put monetary, fiscal, and supply chain as your top three, right? And monetary and fiscal have already, started to move the other way. Supply chain, I think, has been a lot slower to reopen than people had hoped. So to your point, like getting that supply chain kind of reopened fully again, I think would be huge. Yes, clearly upside risk to commodity prices, definitely. But I think, just reintroducing Chinese demand back into the story would be a net positive to the extent that happens.
Stuart Kaiser, great suit, Stu. I thought that anyway. Stuart Kaiser of Citi. Good to catch up, sir. Good to see you again. Thank you, buddy. Equities right now, 10, 11 minutes into the session, up by 1% on the S&P. On the Nasdaq, up by 1.25. Equities rallying, bonds are rallying. Your 10-year yield is down by 9 basis points to about 3.96. And in the FX market, dollar's weaker. Euro dollar right now, 99.39, positive 0.6%. Dollar's weaker, euro is stronger. Coming up, Elon Musk looking to make his mark on Twitter.
I think it's going to be completely revamped over the next year or two. I think subscriptions are limited as the long-term strategy for Twitter. Good strategy, but they don't dramatically move the needle. So I'm skeptically watching this from a distance.
That conversation up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors? And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Is going to be completely revamped over the next year or two, and I listened to Musk very carefully for the last 6 months. I didn't necessarily hear business plans. I think he had a lot of other reasons for owning the asset, and so it's his now. I think subscriptions are limited as to long-term strategy for Twitter. Good strategy, but they don't dramatically move the needle. So I'm skeptically watching this from a distance.
Elon Musk shaking up Twitter with talks of job cuts, leadership changes and fees. Fresh roadblocks standing in his way, though, amid another complaint on Capitol Hill. Democratic Senator Chris Murphy expressing concerns over Saudi Arabia backing for the deal. Joining us now is Bloomberg's Ed Ludlow in San Francisco, alongside AMH down in D.C. Ed, first to you. All I've heard about in the last 24 hours, fees, and more fees.
Yeah, and in the background, the people trying to sort out what's happening internally in the product are leaving. Sarah Personet, the chief customer officer, confirmed Monday she's departed the company. Bloomberg reporting overnight that Nick Caldwell, Twitter's head of engineering essentially, and Jay Sullivan, who's the GM for the revenue and customer product, we've reported have and will leave the company. Inside of Twitter, managers have been working with Tesla staff, John, to draw up lists for layoffs, and they're basing individuals on that list on their contributions to Twitter's underlying source code during their time at the company. One source told me that product managers at Twitter were asked over the weekend to target layoffs that would reduce headcount by 50%. I think one of the critical things we're reporting overnight, not just that Elon Musk is trying to bring back Vine, the video functionality, not just that they're looking at pricing for verification and the blue check mark to have a kind of hybrid subscription and ad-based model, but that they've frozen the policy tools that the trust and safety team used to enact content moderation and policy actions against accounts that violate rules. There's a lot of concern from Twitter insiders about what this means in the context of the midterms being 7 days away. Sources tell us that in the Brazilian elections, for example, over the weekend, there was some limited content moderation activity. But what's happened is the pool of employees at Twitter that are carrying out these policy inactions has gone from a group of 150 down to 15. 15 is what we're told, and there's a lot of concern inside about this company being short-handed when it comes to handling the midterms next week.
Anne-Marie, as you might have guessed, one half of DC is happy about this, the other half not so much.
Yeah, that's exactly right. And Jonathan, what we've seen from Senator Murphy, another Democratic senator, drawing concern and ire about this purchase, what he's looking at is the fact that the Saudis have some money behind this and were able to help make this happen for Elon Musk. You could see it right there. We should be concerned that the Saudis, who have a clear interest in repressing political speech and impacting U.S. politics, are now the second largest owner of a major social media platform. He says that's a clear security issue. We also heard from Senator Warner. He said his big issue is potentially the fact that Elon Musk could be pressured by China. Why? Because Tesla has a massive factory in China. So you see a lot of these concerns is on the heels of some of our reporting that the Biden administration was also potentially going to look into a review of this. But just because they're calling for some of these senators a CFIUS review doesn't mean they'll actually trigger it. But they are definitely using this moment to try to poke some holes into this deal, Jonathan. For me, I just want to know if Vine's coming back, because that was the original TikTok. And there's one thing that has a lot of bipartisan backing in Washington, D.C., and that's the fact that TikTok is owned by ByteDance, which is a major Chinese company.
True. For a moment, I thought you were going to get excited about doing Vines. AMH.
No, I think that's too Gen Z for me.
We'll leave that to Ed Ludlow, AMH, to both of you. Thank you. It's so not me. On the S&P right now, we're positive about 5 or 0.6%. Fading a little bit on the NASDAQ, we're up by 0.7%. Got some economic data moments ago. You'll have more in about 10 minutes' time. With that data, here's Mike McKee. Morning, Mike.
Morning, John. I'm kind of waiting for the AMH Ed Ludlow synchronized dance moves on Vine. I guess I'll
take
wait
a pass.
while. Some new numbers out this morning. S&P's PMI numbers for manufacturing go up. A little bit of a surprise this month because we've been expecting declines, and we're expecting a decline in the ISM at the top of the hour. 50.4 is the number, up from 49.9, and it suggests we're back in positive territory. Now, whether that means a whole lot to the markets or the Fed, other than being slightly disappointing, is another question, because the ISM gets all the publicity. And if you're going to watch the ISM this morning, it's not going to be the headline that really matters. We are expecting a slight drop, but what people are going to want to see is new orders. Are they holding up? Prices, obviously, because of consumer price concerns, the inflation concerns, employment, and supplier deliveries. If supplier deliveries rise, that would push down the overall index, but be seen as something of good news, because it would suggest that supply chains are starting to get better. We also get jolts at the top of the hour, and that's been the key number for the Fed, citing it as a reason to keep raising rates, the number of job openings out there. And also, back in March, Jay Powell said the quits rate was something that was very important to the Fed. They watched that closely. So we'll see that at 10. Powell in March also noted this, something for keep an eye on today and in the next few days. That's the 3-month T-bill and the expected 3-month T-bill 18 months from now. It's about to invert. Powell said that's the most important curve of any that the Fed watches. We'll see if we get to inversion, because he said that's a sign the Fed has to think about cutting rates.
I'm sensing that might be a question from you in that news conference tomorrow. Mike, I wonder if also there'll be questions about that letter we just saw from congressmen and women down in Washington, D.C. on the Democratic side to Chairman Powell.
I suspect that the Fed will completely ignore that. They're going to raise rates 75 basis points, ignoring the fact that there's an election a week from now. And it sort of reminds me of when you tell a teenager not to do something, that guarantees they're going to do it. The Fed has said, we are absolutely going to stick with our process. And the Democratic senators telling him not to is only going to stiffen their spine, I think.
You can tell, Jay, that you just described him as a teenager tomorrow, Mike, when you speak to him in that news conference. Mike McKee, thank you, sir. Some people might say that it's the market that are toddlers and the Fed's the parent, but I think there's been a role reversal in the last year or so. fact, the last couple of years. In the equity market on the S&P, up 0.4%. Energy leading the way with a sector price action. Let's get to Abby. Morning, Abby.
Hey, John. Well, it's interesting because you, of course, were talking with Kaylee about that speculation about a China reopening and also with Stuart Kaiser separately. Well, that is influencing the sector picture because of energy being higher. Oil is up more than 2%, and this is on that idea that if China reopens, there's going to be much more demand. So energy, as you just mentioned, the top sector up 1%. We have pretty healthy sector composition here with most sectors higher, but we are off the highs for the S&P 500. That said, we are carrying through October's big rally. To the downside, utilities down ever so slightly, down 0.3%. Even though yields are down, that should, in theory, make utilities and the dividends that those stocks carry more attractive. Now, if we take a look at the last month, it is all about, well, today's top sector, energy. Energy is up 26% over the last month. The oil and service sector is also soaring up about 39%. And then you can see two big, I mean, gosh, John, take a look at that. ExxonMobil up 28% in a month, and then Halliburton up 51%. Just incredible, the moves. You know, for stock investors, portfolio managers that have to be invested, well, energy seems to be the safe spot.
And not just energy, it was the banks over the last month as well. Just super impressive. Abby, thank you. Great work. JP Morgan up again. Banks doing okay, even in the face of this bond market move. 10-year yields down by
Consumers are very aspirational. You've got millions of people riding motorbikes, and they want to be riding inside cars. Vingroup, Vietnam's biggest conglomerate, has really tapped into that. The founder and chairman aspires to be the Elon Musk of Vietnam.
Vuong is Vietnam's richest man with outsized ambitions. He wants to sell cars not only to the Vietnamese, but also Americans and other consumers around the world.
If VinFast is successful, that goes very well with the ambition of the Communist Party of Vietnam. But if they fail, it will be very hard blow to Vingroup and also to the national economy.
Equities up, bonds up, yields lower. Those moves fade a little bit, though, over the last 30 minutes or so. 25 minutes into the session, equities up 0.5% on the S&P. On the Nasdaq, a similar move. In the bond market, 2s, 10s and 30s. Yields lower, just not as low as they were a little bit earlier this morning. On the front end, we're down by 5 or 6 basis points. On a 10-year, we're down about 6 basis points as well. That's the price action. Here's your trading diary. JOLTS data at the top of the hour. ISM data as well. Biden discussing prescription drug prices at 3 p.m. Eastern. A Fed decision and Chairman Powell news conference coming on Wednesday. On Thursday, a Bank of England decision as well. Jobless claims in the mix, and finally closing out the week with the main event. It's payrolls on Friday. Your estimate in our survey right now, the median estimate, 191,000. The previous number was 263K. From New York, that does it for me. I'll see you tomorrow. This was the Countdown to the Open. This is Bloomberg TV.
Okay, so you're moving in on me. Quick. Distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, Pepsi goons bomb their own trucks. And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning 1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained one man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Weinergold as an opportunity to leave that troubled home. Weinergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Weinergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Weinergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Weinergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if they, if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake. right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers. One of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache,
I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and right up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwit, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, the hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350.
Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign the ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While while the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds, they can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally miles, a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching, trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. While that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.